and welcome to Morningstar. I'm Emma Wall and I'm joined today by Robin Milway, manager of the New Capital Dynamic European Equity Fund. Hi Robin.
Hi Emma.
So you're here to highlight 3 stocks today. What's the first company?
So the first company, Deutsche Börse, they run the German stock exchange and also a collection of OTC and derivative exchanges, largest ones across Europe.
And why do you like that stock?
Well, we like it because since they've just announced last month that they want to take over the London Stock Exchange to create a pan-European, powerhouse in terms of financial transactions, settlements, clearing. It would just dwarf anyone else globally, let alone just in Europe. But the reason why I particularly like the stock at this minute is because we feel there's a bit of an asymmetric payoff in terms of owning it at this point in time. Since they announced the deal, and we owned it pre-deal for reasons which I'll come on to, since they announced the deal, the stock's drifted down. Been weak over particular people concerned about the synergies between the deal, people concerned to a certain extent about an external force taking over the LSE, etc. And so there's always concern. But we feel that the stock was particularly cheap in the first place, given the strength of management, and there will be significant upside in terms of the actual company once the deal goes through.
And the deal will definitely be going through, because there's been a lot of M&A chat over the last couple of years and not everything's come off. We
believe that the LSE will be sold to someone. Now, it's unlikely, even that if the Intercontinental Exchange, ICE, from the US come in with a second bid, which they may well do, it is unlikely the regulator will allow that as a result of the level of indebtedness that the two companies, the combined companies, will face. We think while the regulator still has yet to rule on it, and the AGM boards both need to go through for both the LSE and Deutsche Börse first, we do feel that there's a better than likelihood chance of the regulator accepting it at this point in time where it has failed before, as a result of the positioning of the two companies and everything all the work that they've done on an upfront basis is to please the regulator.
And what's the second stock today?
Prosegur, which are a Spanish security companies. The reason why they're both pan-European and also Latin American in outlook, with a growing business in Asia, places like Singapore, Australia, etc. The reason why I particularly like the company, we've owned them for quite some time, is they're owned by the management. Management were the founders of the company, and they have by far the best reputation from a conservative aspect in terms of running the business compared to peers, for example. So their peers would be companies like Group 4 Securities, G4S, and the likes of Alumis maybe, or a Securitas. And they've got a phenomenal track record of creating revenue growth and also profit growth when macro environments have just thrown the kitchen sink at them. So they've been able to grow the business over the last 20 years, even despite depression, currency devaluation, hyperinflation. All of these things have been thrown at this particular company, not just in Latin America, but in Europe as well. And they've managed to grow the business. It's really quite a phenomenal business model. You
mentioned there who their sort of competitors within the sector are, and G4S overtook Walmart as the largest employer in the world in recent years. I mean, it's not exactly had a great run, with the Olympics sort of a blot on their past sheet, but it is one of the biggest companies in the world. Mm-hmm. How do you take on a giant like that and come off well?
Well, a great little anecdote which Prosegur have said to us before is that the reason why they can compete simply with a company like a G4S is you don't mix the guns and the brooms. So the business model is very different. So whereas G4S are more towards the facilities management route in terms of running the buildings, providing the cleaning, etc. Prosegur solely focus on the security the guns side of things, and it's that focus, it's that level of focus, it's management incentivization based on that level of focus.
Sticking to their knitting.
That is what gets you past the post every time, in not just their industry, but we feel in pretty much every industry going.
And what's the third and final stock?
So the third stock is WH Smith's in the UK. Now, we've had a phenomenal run, and the reason why I highlight it is more of a general kind of concept, in the sense of This is a business that has managed to, again, eke out returns when they've had the kitchen sink thrown at them from a macro perspective. Over the last, 2015 was the first time that like-for-likes and revenue growth was not negative in the company. So that's a phenomenal job. And yet, during this time, over the last 15 years almost, this company has grown profits. Well, they've trebled profits, and the stock's up 150% in that time, led by Stephen Clarke in recent years. Stephen Clarke, CEO, he was instrumental in the turnaround of the high street. And when you pair that with the travel business, which they have, which has been phenomenally growing with great margins, then the stock's been an absolute star performer in the portfolio and also in the UK index.
Robin, thank you very much.
Thanks, Emma.
This is Emma Wall from Morningstar. Thank you for watching.